Hello, this is Glynn Tonsor. I'm a professor in the Department of Agricultural Economics at Kansas State University. I'm making this recording in advance of Stocker Field Day, which normally is held in person and is being held virtually this year. I hope you find this recording and the broader meeting informative, enjoyable, and I hope you find value in it on your own operation. You will be able to find the PDF of these slides. I'm going to provide a link to that at the end of this recording, and a host of supporting information will also be available. As most of you know, I like to start Outlook talks very broad, give a quick overview of the overarching situation. So first and foremost, from a beef supply perspective, commercial U.S. beef production appears to be peaking. Note here initially, we had year-over-year gains the last several years, almost a 4% increase in 2017, 2.5% in 18, a little over 1% in 2019 compared to the prior year. Here in 2020, basically coming in flat, maybe up just barely compared to 2019. Of note is that more than offsets the decline in the second quarter. So year-over-year production in the second quarter was down over 11%. That was the COVID bottleneck, which I'm going to talk more about here in a minute. But pulling cattle forward in the first quarter and then ongoing adjustments the rest of the year is going to put 2020 beef production basically on par with 2019. Looking forward out to 21 and 2022, LMIC is projecting declines, about 1.5% decline in 2021 and maybe a full 2% decline in 2022. The real leverage and the action, so to speak, now that we're past, and I hope we're permanently past, the bottleneck on processing cattle is on the demand front. So beef demand is key to supporting prices. You've heard me say that lots of times in the past. As we're in the midst of this pandemic, I do hope the worst is behind us, but we certainly have a very mixed bag of beef demand signals. I'm going to try to break some of that down here, but that's where the bulk of the uncertainty is at, not so much on the supply side today, more on the beef demand and therefore cattle demand side of the equation. One way to draw this, a bow around this before we get into the nitty-gritty details is to look at the prices. So 5 market fed cattle prices, 2019 was basically flat, 2020 down 7.5%, 2021 looking at maybe a 10% increase. Now, of course, that is basically because of the pullback that's happened here in 2020. Keep in mind what a year-over-year change really means. Southern Plains yearling prices, 7-8 weights. 2019, we were down 3.5% compared to 2018. Here in 2020, it appears we're down about 4%, and then up maybe 8%. Nice recovery there in 2021. And then look over to calves, 5-6 weight Southern Plains series was down nearly 5% in 2019 compared to 2018. Here in 2020, maybe down only 3% or less. We'll see that in a chart here in a moment. We've had a nice bounce back compared to earlier April price lows, at least in terms of projections for fall prices. And then out in 2021, 5-6 weights looking to be up about 6% compared to 2020. All those numbers reflect LMIC forecast as of September 15th. I want to interject here a summary, and I've done this in a lot of other venues, but some of you may not have seen some of those recordings in other webinars, but there's at least 3 major shocks that the COVID pandemic has put into the U.S. beef cattle industry. And I think that's important to understand. The first shock is the stay-at-home orders. So I've put here a timeline, covers the month of March into early April, and the bulk of the residents, because of population differences in the majority of states, but not all states, implemented some versions of stay-at-home orders as we went from March 18th. March 19th was California started this sequence. South Carolina was the last to implement one there on April 7th. Why is that relevant? That changed exactly where consumers were buying their food, where they were consuming their food. Here's a chart from the monthly Meat Demand Monitor project that was launched here just before the pandemic, supported by Beef and Pork Checkoff. The blue bars are what I'm going to highlight because they're the lunch meal. Has probably been impacted the most. And you will see in February and the first half of March, 30 to even 40% of lunches were consumed away from home. Red bar draws your attention to that. Starting the middle of March through the month of April, the percentage of meals for lunch that were consumed away from home was much lower. So 20 to maybe 25% was much more common. Why is that relevant? We don't consume the same type of protein, same products away from home as we do at home, and that led to a lot of product level differences. We actually had periods where wholesale beef prices for round, which is a primary source of ground beef production, were on par with loin, which of course is where we get some of our better steak products from. That is not normal, and that is not good from an aggregate beef demand perspective because we lost the ability to get higher value out of the loin, primarily because of the food service decline. Second shock that happened was the bottleneck and the challenges on processing animals. Here's a figure and a link to the paper That's a working paper I wrote with Jason Lusk at Purdue and Lee Schultz at Iowa State University. I've worked a lot with those two throughout the whole pandemic on related issues. And you can see here as April progressed, our ability to process cattle became quite constrained. So in the first quarter, we actually pulled cattle forward. We had year-over-year increases in the number of animals slaughtered. Early in March, you can see some spikes around that front, industry trying to get ahead of this, so to speak. And then as we progressed through April, we actually got to where almost 40% lower cattle processing, federally inspected cattle numbers compared to same point in time in 2019. That is the bottleneck I'm referring to, is we had a disruption in the ability to produce beef, and we started backing up cattle. So those fed cattle carryovers and backlogs in the feedlot became part of this story through starting mainly in April, and we still talk about it today, but that situation has improved quite a bit. The bottleneck, here's an image of that. It's kind of the pinch point is when we harvest animals. There's fewer of those entities in our industry for a long list of reasons we could talk about. Economies of scale is key to that. Probably the first time, at least in my lifetime, and for many in the US, we talked about quote unquote shortages. I tried not to use the term shortage because I thought it was misleading. There was no shortage of livestock. We certainly had plenty of animals in feedlots and hogs in market hog buildings and so forth, finishing facilities. But nonetheless, the term shortage was being used. Even Time Magazine, CBS Evening News took note. US consumers took note and questioned our supply chain more than ever before. In hindsight, I will tell you, not only was shortage a little misleading, because I knew we had animals sitting and waiting, but consumers actually loaded up on their meat. You saw the commentary about ground beef being ran on, grocery stores, running out of ground beef and so forth, was partly because the public was loading up, filling the freezer and the fridge with ground beef. And folks actually entered the month of May, most people with more meat on hand than normal. So only 14% reported they had less meat on hand early in the month of May than normal. So I do empathize with those 14%, but they were the minority. And the commentary about shortages was a little bit misleading, thankfully, because the industry was able to turn the corner quicker and stronger in terms of production of meat in general and beef for our purposes here today than a lot of people were expecting. The third major shock, which is ongoing for sure, is the consumer demand aspects of this. Normally, economists would say we expect weaker beef demand when we have a recession. And we certainly are going through a recession. The second quarter was unprecedented in many ways. Beef, being a more expensive protein, tends to be more sensitive to consumer incomes, more generally consumer sentiment about the economy. So we anticipate weaker demand. That's been offset in no small part by unprecedented federal stimulus. So the CARES Act, the fact that something like 85% of US residents got some component of federal stimulus and spilled that over, some work would say, into more food and even more narrowly meat purchasing, has certainly offset some of those concerns. So that's been supportive of demand. How long that'll persist, what future stimulus efforts there are, and so forth is certainly an arena of current macroeconomic uncertainty, and we need to monitor that from a beef demand perspective. The other thing is still fleshing out here is, and it relates to shock number one, is the growing importance of at-home meat supplies, meat consumption at home, rather. That has kind of a mixed bag. So I made the comment that that's presented challenges for valuing loin products, but it probably boosted the demand for ground products. As that meshes out and how long those patterns are in place, to the extent that people work at home longer than anticipated and go back to restaurants slower than some hope, we need to monitor that. I do think it presents a very mixed bag of impacts. It calls and highlights the importance of monitoring food service separate from retail, for example. And to drive this point home is the uncertainty in the macroeconomic aspects of COVID. We get updates on this all the time. One of the things that was came across my desk about 2 weeks ago was this chart from it's the Daily Shot, which is a spinoff from the Wall Street Journal. And it basically, to paraphrase, is what we were hoping were temporary layoffs are increasingly becoming permanent. That's why you interpret that bar chart there. That is going to put some pressure on aspects of food demand as we have permanent loss of jobs when we were hoping for it to be not permanent, of course. I highlight a book here for those of you that are just kind of fellow geeks like me, you want to understand this more. Tyler Cohen wrote several years back a book called Average is Over, talked about the change in the role of service jobs and specialization and so forth. I think that has a role here. I don't have space to talk at length about it during this session, but I encourage you to look that up. So go further this demand update. Those are the shocks on COVID. Where are we sitting? Several of you probably know I monitored beef demand several different ways. One way is monthly updates using USDA data. This is lag looking backwards. we now can look back and say in the month of April and May, we had weaker beef demand per this measure than we had in 2019. To me, that suggests that the restaurant, food service, more broadly, HRI channel weakness was a bigger pullback than the strength we saw in the grocery store. So as consumers went to the grocery store and purchased food for at-home consumption, that was a boost, but it was offset in many ways, specific to the all fresh beef demand index I maintain, by weakness on the food service side of things. June, we had a spectacular recovery. You can see a big spike to the far right of this chart, and July was a bit mixed. It's worth monitoring this going forward. USDA does revise the prices they use up to 3 months later, and I'm going to be monitoring that June price for sure. On the export front, there's also some challenges that the beef industry's had. You can see a dip in this U.S. beef export demand index that occurred during the pandemic. We have had nice recovery recently, but that needs to continue. There are some reasons for optimism. The weaker U.S. dollar in the past few months should be helping our exports. Stronger Asian economies compared to the rest of the world, hope persist, because Asia is not the only, certainly, but certainly one of the main supporting sources of import demand for U.S. beef exports. And then, of course, you have to be able to produce something in order to have it available to export. And the fact that we have federally inspected beef production volumes back up to on par with prior year simply means those pounds are more available to export. One of the reasons our volume of exports was constrained was obviously the pounds weren't available, and the U.S. dollar prices earlier during the pandemic were making our products quite expensive for what was being produced. So what's the cattle price outlook? Let's summarize some of those points here. Here's a price chart. Some of you know I like to bring from LMIC. These are updated weekly. This is the 5 to 6 weight Southern Plains chart. The solid blue line is for the current year, 2020. The dotted line or dashed line is last year, 2019. You can see we started the year kind of on par, tracking 2019. And for the first couple months, that's exactly what we did. But then when the pandemic hit, you can see kind of the floor fell out of things. And through the end of March, pretty well through July, we were well below prior year prices. But we've had a nice recovery since then. And in many ways, projections for calf prices are within $5 per hundredweight for fall sales, which is relevant for most cow-calf producers, to what they were pre-pandemic. So if you compare projections around, say, February 1st with what's being projected here in the middle of September, you will find that projections for October are within, like I said, about $5 per hundredweight, which is quite remarkable, actually. The specific number I'll give you using beefbasis.com for the Salina market as of September 21st was an early October price of about $162, which again would be on par and slightly ahead, actually, of what we were last year per this chart. What about margins for the cow-calf sector? Here's a chart that LMIC maintains. Its return over cash cost. You can see the red bar there in 2019 was a loss of $51. Currently, LMIC is putting out a projection of a minus 17 for 2020. That's quite remarkable. I mean, if you would ask me, could we go through a pandemic and the average cost producer might have roughly a break even, which minus $17 is close to break even, would you take that? I think a lot of producers would take it. You never get excited about a loss of $17. I obviously understand that. But given the scope of disruptions this has had, not just on the beef industry, but society more broadly, in many ways, that's a win. It's also of note is the second round of stimulus, more broadly, the role of stimulus and those forms of compensation for producers are going to make that situation better. Looking out to 2021, plus $80 is the current projection LMIC has out there, consistent with the 5 to 6 weight calf price I showed earlier, and a little bit of cost improvement that's built into those projections. So getting back to the stocker phase specifically, I encourage anybody that's marketing feeder cattle and looking to put weight on them to use beefbasis.com. So if you're marketing feeder cattle and just looking at the sales arm of this, for example, looking at selling off the mama cow here in October, I've already given you this number, expected cash price of $162, but you can use this beefbasis.com resource on your own to get a projected sales price on its own. The real value and the most unique part of this tool is to get at the value of gain of putting additional pounds on. So I'm going to give you a couple of different scenarios here. What about the winter backgrounding situation? These are all as of September 21st. But what about taking that 5.5 weight in Salina, Kansas on October 7th, and rather than selling it, you retain it or buy somebody else's if that's what your business model is, and plan to sell on January 13th at around 725 pounds. That's days on feed just under 100 days. Average daily gains about 1.8. I already told you the expected buy price is 162. Expected sale price from this tool is 147. Calculator behind the scenes here is using futures market and historic basis relationships to come up with these projections. The value gain that implies is $98 per hundredweight or $171 per head. I would encourage you then, of course, to compare that to your own cost, your own appetite for being exposed to the feeder cattle market, price risk, and so forth, of course, plays into that. But that is an attractive value gain that's going to get the interest of some in the industry. What about looking forward further into 2021? What about a summer grass situation where you might buy a 7-weight, 725 pounder specifically scenario I looked at early in April and sell around Labor Day at closer to 1,000 pounds? That's 154 days on feed is the scenario I use, sticking with right at about 1.8 for your average daily gain. Expected buy price is about 150, looking out to April. And the expected sale price, there's a typo, that needs to be 137, not 1137. That implies a value gain of 104, and that's about $284 per head. Again, I would encourage you to compare that with your cost, your interest in being exposed to the market during that point in time. The physical decision to buy, of course, is not until next April, but it's never too early to start monitoring that and thinking through how you're going to set up your operation. That brings up this tool. I've noted this in past Stocker Field days, but I think it's probably never been more important. So Kevin Duvetter built originally this KSU feeder cattle risk management tool, and I maintain it, put some tweaks in it over time. This is used for comparing alternative ways to protect against downward movement in feeder cattle prices. It's an Excel-based decision tool. Here's the link. I encourage you to make use of it. One of the things that it does is compare the do nothing or cash strategy with futures hedges, so CME board hedges, put option futures contracts, or the LRP option, which is livestock revenue protection, which is a USDA product. I'm noting the latter because there's been yet again some changes to that this summer. USDA announced there's some enhancements of that product. I'm not going to read all those details to you. Here's the link. I encourage you to go study it. One of the things of note is the subsidy has been increased. So the federal government, via taxpayer resources, is going to pay a higher share of that price coverage and the producer less than in the past. So if you've used this tool in the past and found it favorable, it's probably even more favorable today. If you've thought about it in the past and were kind of on the fence but chose not to, it might be more favorable today. Or if simply your risk appetite has changed because of COVID or other things, I encourage you to use that decision tool that I noted on the previous slide and use these changes on the LRP offering to help modify and update your decision-making process. Let's round this out. Let's look at the feedlot side of things. You might remember from past discussions, once a month I put out a projection of the Kansas feedlot profitability situation. I'm using information from the Animal Science and Industries department that leads the Focus on Feedlot survey, and I'm bringing in a bunch of Kansas market information, feeder cattle, fed cattle, corn prices in particular. I've put green bars around the closeouts for the month of September through March. So when I updated this on September 14th, you come up with projections for non-hedge situations that are positive for September through March. They look the best for the month of October, but they are $30 to $100 positive margins, and they reflect notable improvement in the fed cattle price situation and the fact that feeder cattle prices were declined earlier, particularly if the closeouts would fall into 2020 yet. So that's a notable improvement for the feedlot side of things that hopefully will offset some of the equity drain that certainly has happened during COVID for those that weren't hedged and or didn't get much stimulus assistance. LMIC puts out these quarterly forecasts. I gave you a few of the punchlines of this when we kicked off this session. First here, I have commercial slaughter, dressed weight, and the commercial beef production. The commercial beef numbers are the ones to the right I shared earlier. I want to break down the 2020 numbers by quarter because there's an important point here. The first quarter, commercial beef production was up a full 8%. However, per capita U.S. consumption was only up 5.5%. In the second quarter, commercial beef production was down over 11% compared to 2019, but domestic consumption was down only 8%. Third quarter, fourth quarter, similar stories I could map out here. What am I trying to press on you? We have had larger changes in domestic production than we have domestic consumption per person for several reasons, but most importantly is the role of trade. Import and exports of U.S. beef products and products from abroad that become part of our domestic consumption have served a role of smoothing the flow and disruptions for U.S. consumers. That is one of the primary purposes of trade, among others, But here in COVID, the pandemic that's ongoing here in 2020, that has been revealed as very important. Some of you might remember in the month of May in particular, that commentary about shortages and the where's my beef slogans were pretty strong. We smoothed some of those disruptions via international trade. We also enabled pulling cattle forward in the first quarter and having exports in place so we didn't have that same volume increase domestically on the domestic market. That helped with the fed cattle backlog that's been talked about. So the role of trade has always been important. I'm quite concerned about protectionistic tones that have been elevated during the pandemic. I wrote a fact sheet to give some context on the historic role of beef exports and imports. The link to that is here. I encourage you to look at that. I hope you find that useful. LMIC's forecast for the price side of things. I gave the percentage changes earlier, but we break down 2020 looking through the third quarter, 5-6 weights in the mid 150s, fourth quarter upper 150s maybe. Fed cattle prices down 5-6% from the year before. Let's jump out to the third quarter of 2021, 5-6 weights, upper 160s to low 170s. Fed cattle price in that 114 to 120 range. The yearling price is coming in the 150s, maybe hitting 161, 162. Out to 2022, we have those prices, but better yet, being projected, mainly because LMIC's numbers suspect beef production's peaking here in 2020, and we're going to have some supply side support to prices going forward in 2021, 2022. In the event that the macroeconomic environment improves beyond what's built into these forecasts, I could build an argument for better yet prices. I think there are some reasons for optimism that global demand for protein will rebound, but that's going to hinge on global macroeconomic conditions and geopolitical relations. We'll have a lot to say about that. So monitor that, and potentially after our election in November, we may reduce some of that political uncertainty at least. That's not to say I'm predicting one way or the other who's going to win, but it'll just be one less source of uncertainty on the markets that I think might be favorable. I'm going to end there. You will find a PDF of these slides on my page. So on our Ag Manager website, I maintain a page that has this and a whole bunch of other resources. I've included some links throughout this talk to several of those. I give versions of these Outlook talks over time, of course, increasingly by distance during the pandemic. That's why we're doing Stocker Field Day virtually, of course. But I hope you find some of those resources helpful. And as I said earlier, I hope you have found the Stocker Field Day informative. I hope there's information from it that can help you not just survive, but thrive. Have a good day.